It'll be a big week.
Morning.
Any chance he disappoints the market, do you think?
There's always a chance, but I think he's clearly been put into a box a little bit. The market wants a 25 basis point cut. He's going to give it to him, and I think it's really about the language going forward from there. How is he going to temper expectations of future rate cuts going forward?
So in other words, here's your cut, and it's all you're going to get for a while?
I think that's what he should be doing. It's going to be a subtle dance to get there, but he's going to have to put himself in a position where he's not beholding to the market at any given point in time.
Dick, how about you? What do you see for tomorrow and Thursday?
I agree with that entirely. I think the fact that the economic data recently throughout the world and even the United States has been relatively weak. There appears to be no great progress on the China trade situation with the United States, and the market has spoken. I think the market actually wants 50 basis points, but that's off the table now because of the strong employment report. And so I think he will, the Fed will move by 25 basis points, and in the press conference, he'll try to neutralize that somewhat by not being particularly bullish in terms of, not being particularly dovish in terms of future rate cuts.
I think the other question, Sean, is what impact will it have on already super low interest rates, a nearly record high stock market, an economy that's doing okay?
I don't think it has much impact on the economy at all, unfortunately. If we look at Europe, Europe has negative interest rates. It's not helping their economy. So in a lot of cases, you're pushing on a string. The market has already made the move. And if you look at rates, they've already established that there's a cut that's out there. So in reality, I don't think it helps the economy that much. I think it's more for the market. And unfortunately, that just creates further bubble thoughts as time goes along.
How does that resolve itself?
I don't think well in the long run. That doesn't mean it happens tomorrow or the next day, but certainly you're going to have a scenario where people are going to be expecting cuts and they don't get them, and there's going to be a problem.
Richard, you seem fairly confident that 50 basis points has gone to 25, given the employment number. Why?
Well, because of the employment number. I mean, basically the economy is doing okay, and I think if the Fed had its own choice, it may not even move at this time. But they're forced to as a result of what's going on. I think the biggest issue going forward is trade. And if something doesn't happen positively on trade, I think the market has at least a 5 to 10% expectation in it already that trade is going to get settled one way or another. If that does not happen, I think the stock market is going to fall by 5 to 10%, and who knows what happens after that. So the trade, it's not interest rates anymore. It's what happens with trade after this next cut.
Right. Although it does put the Fed in a difficult position, as all of us as well, trying to figure out what's going to happen on trade is a fairly difficult thing to do at this point, isn't it?
Well, it is, but remember, we're talking another 6 weeks or almost 7 weeks from now before they have to make another decision. If there's no indication what's happening, positive or negative, in 7 weeks, that's negative. So they're going to have to deal with that, and by then I think the market will be either down because they don't think anything's going to happen, or it'll be where it is today or a little bit better if we get some sort of good news on trade.
You've been net cautious for most of the year, right? Has this summer action surprised you?
It has surprised me. So the first 3 months of the year, I was actually bullish coming in, and then I got cautious. So I missed, the last 500 basis point move in the equity market. But the reality is, it's just about probability analysis and looking at, capital and deploying capital. It's what risk are you willing to take versus the opportunity set that's out there. And I think the market has continued to push higher because it's present valuing earnings based on really low interest rates for a long period of time. And I think that's a dangerous game over the long run.
So, Richard, what about your industry, the banks? How much do you think this discussion of lower interest rates and the expectation that the Fed is going to move has been an overhang on valuations?
Well, it certainly hasn't been a positive, and there is there's certainly some overhang of that. But again, I think the economy is even more important than the rates. I mean, if the reason rates will go down is the economy isn't doing well. And if the economy is strong, then the rates will stay where they are and so forth. But, you know, banks are cheap today. They have high dividends. I think the negative is already in the prices of financial institutions of relatively low interest rates for a period of time.